Everyone is saying that the stock market is at all-time high right now. And what if the stock market were to burst? How should I position myself this time? Now, as an investors, why do they have this question? Is because they might be fearful that they did not lock in the profits that they had. So how should someone go about doing this? Now, I want to introduce this book to you called The Psychology of Money. Now, this author has sold his book millions of copies, and he talked about this topic as well. So one of the things he mentioned is to have bonds and stocks at the same time. Because naturally, for investors who have been riding the bull market has accumulated a large chunk of profits. And if you kind of interrupt your profits, like what Charlie Munger has said, the first rule of compounding is not to interrupt your compounding unnecessarily. So the doctor actually talked about including bonds in the investment portfolio. Bond is something that you buy that kind of pay you a fixed return. It can be a bonds from the government. It can be bonds from the corporate sector. So naturally, if you're somebody who wants to have a fixed return, they will consider bonds. Why did the author mention this in the book is because the psychology of an investor in the bull market is that they are fearful that the profits that they had, and if they didn't lock in, they might feel miserable about it. So the author talked about having certain ratio of money in bonds so that even though the bull market continues to go up, you have certain assurance that the bonds will give you certain fixed return and you are enjoying the ride in the bull market. And yet at the same time, when the bull market starts to go down, you can actually shift your funds in the bonds to buy the stocks that has been priced lower when the bull market starts to soften. So as an investor, you got to ask yourself, what kind of ratio do you want to give yourself? Are you going to allocate 20% in bonds, 80% in stocks? Or are you somebody who is more fearful where you want to give 40% in bonds and 60% in stocks?